Let's move on and welcome in Prakash Diwan. Talk about individual stock ideas, fundamentals as well. Prakash, good morning and happy Monday to you. Since I was just talking with Narayana, let's start there. The healthcare space, hospitals, healthcare. Any interest? Do you like any of the stocks, whether it's Narayana or maybe the larger players like Apollo?
Good morning, Surbi. No, lots of interest in Narayana itself, and NH has been one of my favorites within this so-called crowded space. And what I love about their business is the uniqueness of the business model. While it's been expanding in terms of not just being asset light, it's actually in a way where they have amazing pricing power. They started with very low price points, started moving into higher end realizations, so throughputs. And remember, the percentage of robotic surgery is going so majorly, it's moving up, and that's very high margin. So if that were to kind of continue galloping the way it is, you'll probably still see some improvement happen in the quarters to come. So absolutely right. And this has bucked the trend. You look at whatever happened to the rest of the market, this was still making 52-week highs. We spoke about it at about 11-1200 just about less than a year back, and look where it is today. So I think it's something which you should look at seriously if you have allocations deemed for the sector. The rest of the companies in the same space are struggling because of very high capex. Their ROCs are still kind of not as robust. So great franchise, great business model, and great financial metrics. So very positive with this.
Okay, all right. Hi, Prakash. Good morning. Let's talk about a couple of these nifty companies that came out with a set of numbers. JSW Steel, the numbers look pretty okay, actually. Good improvement in the EBITDA per ton on a sequential basis. And what's encouraging is they've got some benefit of lower coking coal costs in the past quarter. They'll get another $10 fillip in the coming quarter. And they'll also get a price increase of around 2.5 to around 3,000 rupees per ton, which will make the EBITDA per ton look even better from here on. Your view?
Oh, absolutely, Nigel. Good morning. So it's a company that doesn't make staple steel or regular steel from 100% of its capacities. I think it has the advantage of making special steel as well, and specialized steel is something which will start continually seeing a lot of offtake given how some of the infrastructure growth is happening around. And remember, the global setup is just getting to be much more positive for metals and even steel. It's not restricted to just copper and aluminium. And if the EU is going to struggle to be able to kind of set tariffs, in a favorable band with the US, given whatever is happening, though we've seen an extension and all those. But I think a lot of steel making from India will start kind of making significant strides from a global context as well. So and then some of these companies like Tata Steel, JSW are now fairly well diversified in terms of geographies as well. So you will have some advantages that roll in. So I'm quite positive. In fact, it's a very decent set of numbers given how things could have been on such a large balance sheet. So they managed to kind of pull it off. And I think it also sets the tone for this continuation of improvement to happen. So with this, without any dramatic price hikes and with any dramatic increase in the market demand for some of this special steel. So fairly a moderate quarter with still, that's where the advantage is. The correction that you saw in the steel companies, Nigel, that's in fact the advantage that you had to kind of get in, because this is a sector, once it takes off, it at least does well for about 18 months. So, these numbers tell you that it could probably be good times for most of the steel players, and this could lead that improvement from here.
Okay, all right. What about cement, Prakash? You get JK Cement. The stock is not particularly cheap. It's very close to its 52-week high. The numbers were good. The EBITDA per ton has improved. The net debt, they've kept it more or less at a stable number. And they're already talking about capacity moving to around 30 million tons, which they've already laid out a fixed plan out there. What's your view on JK Cement? And also, I wanted to ask you about the other one that's not very cheap is Ramco Cement. The numbers are disappointing. You had a big fund coming in then buying a few lakh shares at around 1,000 rupees per share. And that's why Ramco, from standing in the red, in fact, went in the green. What's your pick from the pack?
So, no, you're right. JK comes expensive for sure. And I think it's more because the market's looking at what's in store for them. Their commentary has been fairly positive. And, they've probably taken a leaf from the Shree Cement copybook. I mean, keep growing organically without much of debt increase, and that kind of starts paying off. It takes a little bit of time in terms of execution, all your expansion, but they have access to raw material. They have something which they can do in terms of a lot of the places that JK is prevalent in. They have access to the backward integration possibility. So I don't see any reason why they will not be able to implement this. And if this is being done with such a low leverage, it's great. Ramco, I don't know. It's probably a bit of that float issue. A lot of buying that comes through, large buying on a particular day, and things look very differently. But the numbers, as you said, are not definitely very encouraging. Out of the pack, over the last few months, what I've noticed is that the larger players have actually started turning out to be much more dependable if you were to make some allocation as the sector starts re-rating itself. There have been some price hikes. You'll probably see much more concerted, east and southern markets kind of rev up. But Shree Cement is something which I want to point out. It's something which has done exceedingly well. It's usually expensive to buy, but it's worth paying that premium because it probably keep improving year on without any blips. So, and then of course you have the ACCs, Abujas of the world to choose out of. But I would believe it. I would stick with the larger ones this time and not those small Dalmia, Bharat, Sagar. And all. There's a lot of activity that was around built around those names. But I think now the focus is going to be on sheer market growth, volume growth, and that's where the larger ones would probably be better off.
Okay, all right. So stick with the big boys. That seems to be the call. Prakash, got it. Thanks very much. Shorter chat today because of lots and lots of earnings,
Yes,
but we'll
no
connect
worries.
again soon. Thank you very much for joining in.